Welcome to the session. Today we talk about risks involved in documentary credits. Documentary credits are regarded as one of the safest instrument. Why? Because they provide one of the best possible risk mitigation. But still there are risks. So what are those? When we say documentary credit is a safest instrument but they are not without risk, here we will explore the five main types of risks involved in a documentary credit transaction. There is a flexibility in the transaction, in the method, in the structure, and there are ways of mitigating the risk, and there are different risks for different parties as in any other transaction, the exporter, importer, and the bank. We will try to see what are the various versatile mechanisms that we do have. Payment risk. What is a payment risk? Payment risk arises when an exporter does not receive the payment, or the payment is delayed unduly. So denial and delay for a payment is called a payment risk. This is despite the exporter fulfilling their part of the contract, that is the performance or the service to be rendered is complete, it is well documented, all the terms and conditions have been met, the claim has been presented, but no payment has come. That is the payment risk. The cause could be issuing bank is insolvent, or it is not able to honor its obligation because of their incapability or wrongful pointing out of the discrepancies, or it could be fraud by the parties, that is a forged document, etc. Now, forged document could also be in another form called fake shipment. That means non-existing shipment, phantom shipments. There is no shipment, but only on paper there is a shipment. There could be discrepancies in the document genuinely, even if it is minor. Only some certain typo errors are allowed. Otherwise, the discrepancies may lead to rejection of payment. What is the mitigate available? Mitigation is that ask for a confirmation from a second bank, which is your local bank, more closer to you, known to you, who will act as your eyes and ears and check the document and let you know where the discrepancies are, so that you can fix the discrepancy. If there is the potential risk of insolvency or instability in the importing country, that will be ironed out by having a local confirming bank. But if the parties collude and if there are forged documents or fake shipments, then there will be no way out. For that, what can be done? Due diligence on the parties involved, the buyer, the seller, the bank, be it issuing bank or the confirming bank, their ability, their historical performance is what one will have to look to. So payment risk occurs when exporter fulfills their obligation but fails to receive payment. Mitigation is to bring in a confirming bank from a reputable country, so which will be more liable to get it paid because they will adhere to 600 UCP, and they will confirm if and only if they find the issuing bank and their country as acceptable. So if there is a Chinese exporter, they are shipping to Africa, the stability or instability of Africa cannot be forecasted, so they may ask for a confirmation from an European bank. So what happens? The risk or dependency is on European bank, neither in China nor in Africa. Now comes the performance risk. What is a performance risk? The risk that the party may not be able to perform. That is, exporter failed to deliver with respect to the quality or quantity or specification or timelines. So potentially this may lead to refusal or dispute or delay. So poor quality or miscommunication or wrong documentation could all be called as performance risk. That is a possibility that the exporter fails to deliver either the goods or the services or the documents on time as per the agreed terms. So the mitigation is that the contractor should have adequate details as to what is to be specified in which document, how and when. Then potentially there should be inspection certificate by parties, third party, who are liable, considered as by the exporter. So that exporter will arrange for that certificate and submit, so that the importer will find satisfaction from a third party verification. Then one need to align the Incoterms with the DC terms, because many times the performances happens because of certain small misunderstanding in the way that trade terms are agreed upon. If an Indian exporter is shipping goods to the US importer, Indian exporter shipping goods to US importer, then the goods may get rejected because of quality. So what is necessary? The necessary document for the importer is that the goods should be of quality. That will be evidenced by a document called quality certificate or inspection certificate that has to be issued by a third party, for example SGS. That inspection will happen prior to the container being locked and loaded into ship. So once that document is called for and presented, the performance risk that the exporter may not adhere to the quality quantity specification is now mitigated. Now let us look at the country risk. What is a country risk? Country risk is that the political instability or the regulatory change or the economic conditions of the country from where we are expecting performance or payment is not satisfactory on the date on which performance or payment is to be made. If the exporter is not able to ship the goods because of the higher tariff, a ban on the export, that's a regulatory change. The importer is not able to pay because of the political instability and unrest, because of which banks are not working or currency is not available or the currency rates are very bad or rationing is happening on the due to effects not available in that country, or maybe there are sanctions on new transactions, or maybe the export import regulation changed or the tariffs have been increased. All this may cause difficulties. So monitor the geopolitical developments, assess the risk, and accordingly decide what could be the way out. Export credit agencies could be of help, confirmed LCs could be of help. So that is all depends on the specific trade between the buyer and seller. Ensuring the transaction from ECA is what many people do when the transaction size is large and a political instability is estimated. What is the currency risk? Currency risk is that the exchange rate fluctuates so badly that the dollar or the euro that you are looking for may not be available, or the buyer is not able to procure, or the buyer is able to procure but the bank is not able to remit because they are not able to fund the foreign currency accounts in the Nostro Center. So volatility in the market, delayed payment due to restriction in currency movement, or more exposure by the country tilting the balance of payments in an unfavorable situation. All this could be the risks. How this can be mitigated? One, exchange rate can be specified in the LC by saying what rate might be acceptable to you. Second, one can use forward contracts to hedge the requirement, and then we can negotiate the payment terms to be acceptable to both the parties to minimize the delays and allow multi-currency payments. Otherwise, if you have a Brazilian exporter and expecting dollar to come in, and they have reduced the local currency revenue because the Brazilian real weakened against the dollar. So this risk can be covered only by way of, for example, hedging. Now let us look at operational risks. What are operational risks? Operational risk is that the errors, inefficiencies, inadequacies of the people or the process or the procedures, or delay in processing the documents or executing the transaction, or mistakes committed by various people in the chain. So mistakes in document preparation, mistakes in document presentation, mistakes in document checking, all these discrepancies could lead to delay or denial of the payment. Delay in communication could also make the payment not eligible for. For example, within 5 days you have to check. If you don't confirm that the documents are compliant or not compliant, then the presenter will have a right to claim that the checker doesn't have the right to claim discrepancies thereafter, that is after day 5. So training of the people, upgrading the skills, using tools and additional softwares, these are better ways. Clear communication, transparency, clarity, completeness in everything that you do, be it a communication, be it a document preparation, be it a clause in the agreement, everywhere. These are the ways in which this can be mitigated. For example, you have an exporter in Australia and they are submitting a bill of lading and that does has an incorrect port of discharge. Then the importer may not be willing to take that BL because a port of discharge is wrong. It is not coming to his own place that he wanted. This will cause delays and costs. Now let us look at what flexibilities are available. Documentary credits offer several mechanisms to mitigate the risks. They provide a flexibility for both importer and exporter. One is confirmation, because another bank is brought into the picture. This should be from a stable country and a more better financial condition, and so the payment is guaranteed by additional layer. This protects the exporter. This adds to cost a little bit and reduces the country and bank risk. Next is transferable and back-to-back LC. In a transferable LC, the original beneficiary exporter will transfer a portion of the LC to the third party who is the ultimate supplier. In a back-to-back LC, the exporter will use the original LC as a collateral to have another LC issued. So in these two ways, exporters can transfer the credit and leverage the LC. This is a flexibility available to mitigate the risk of availability of a performance guarantee or a payment guarantee. Then deferred LC and negotiation terms. Deferred payment LC allows the importer to delay the payment till that maturity date of the bill. This will ensure the exporter will receive the funds from the bank, because this can be discounted or prepaid or as per the agreement between the exporter and their bank managed. Negotiation means the exporter can negotiate the LC bill with their bank and get payment before the payment is due from the issuing bank. So this will improve the cash flow. This will help with the working capital management. This will provide flexibility in payment, and you will pay interest only for the discounted period. So accordingly, you can control the cost also depending upon the requirement. What are the different risks? For the exporter, the primary risk is non-payment. Then comes a currency fluctuation, because your realized value will be lesser or more, we don't know. And third is the issuing bank, issuing country risk other than the documentary risk, which can be mitigated by confirmation. Currency risk can be mitigated by hedging. Documentary risk or discrepancy risk will have to be mitigated by expert training and proper attention to the LC terms. What are the risks for the importer? This is the receipt of substandard or delayed goods, that is non-shipment or non-performance. This can be managed by inspection certificates from a allied third party. And then operational delays and impacting business. This can be managed by mentioning in the letter of credit when the goods should be shipped, when the document should be presented, when the documents will expire, LC will expire, etc. So that the terms are aligned and the Incoterm and other things are properly specified. What are the risks to the bank? Fraudulent document, phantom shipment is a collusion between parties, is a risk to be considered. The liability under UCP 600 for non-compliance is very important for the bank, because if the bank doesn't go back to the presenter by the end of day 5 saying the documents are clean or discrepant, then they are precluded from claiming discrepancy at a later date. So the risk against the applicant not paying can be taken care by way of due diligence on the applicant. The risk of beneficiary non-performance or fraud can be taken care by way of due diligence on the beneficiary. This is how banks will be able to mitigate the various risks that they face in a letter of credit situation. Let us look at a situation where importer in US is buying electronics from an exporter in China. They have a currency risk here, and they have a situation where regulations or tariffs may kick in. Because the US is an importer is in US, getting the LC confirmed from another bank in US may or may not be helpful. Preferably it should be confirmed by a bank outside US from a textbook angle, but confirmation from an US bank is also acceptable. What can we do to ensure the Chinese exporter will ship as expected? For that, we can call for an inspection certificate that will ensure quality. Also, what is the guarantee that the Chinese exporter will not get the money? So to protect against the US and the US government and the US importer and the US bank's behavior, one can ask for political risk insurance so that country risk is covered. To cover the renminbi rate versus US rate, one can go for hedging the currency by options and forwards. And we can use the latest technology to ensure documents are not discrepant documents are compliant from the UCP and LC angle. So this will ensure exporter will receive payment on time from the confirming bank or the export credit assurance agency, irrespective of whatever happens in the importer's country. Thanks for watching this video. We shall catch up again in the next session.